Welcome to RenMac Off Script. We openly discuss markets, economics, policy, history, and life. It's the 6th of September, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC, and most of the time our LinkedIn page when we remember, but you're better off following us on Twitter. And in case you don't get enough of us, you can go to YouTube. We have a YouTube channel where we host this and some other videos on educational stuff and just kind of how we're thinking about the world here and there. Well, it's Payroll Friday, so Neil, you got the floor, but most importantly, you think the data supports 50, so why don't we just get right into it with the gloves off and start swinging?
Well, I think, so there's a couple, obviously a few points I want to make. I mean, number one, the pace of employment growth keeps slowing. So in the last 3 months, private payrolls on average have gone up just 96,000 per month. That's actually a fresh low. What's interesting about that is you've actually seen construction employment rise by 22,000 a month on average over that 3-month period, which is pretty interesting given how weak residential activity's been. You also have seen manufacturing employment come down quite a bit. Factory jobs fell by 24,000, and it's contracted about 1% annualized over the last 3 months. I mean, for manufacturing, that's a pretty meaningful drop, particularly machinery manufacturing, not a good sign for CapEx. With the household survey, yes, the unemployment rate ticked down to 4.2%. But I mean, I don't know why people are celebrating that. I mean, if you look at the underemployment, it's been going up. So if you look at as a share of the labor force, part-time for economic reasons rose to 2.9%. That's a fresh high, clearly above where we were before the pandemic. So, for the Fed, Nick Timros of the Wall Street Journal had an interesting piece talking about how this number was going to make or break the debate between 25 or 50. And unfortunately, I don't think in terms of how they would read it, not me, them.
Right.
It's not overwhelming one way or the other. There's no obvious kind of signal, I guess you could say. But I think if you're the Fed and you're a risk management business and what you know about the outlook, what about this jobs number tells you that things are just going to stabilize here on their own?
Right.
What about the inflation outlook tells you that things won't inflation won't continue to run below 2%?
Yep.
That's what we've seen over the last 3 months. So to me, it's about risk management, So I think that I have this weird kind of sense that Powell's already made up his mind. I mean, he was very dovish at Jackson Hole relative to a lot of his peers that have come out before and since. I think he's got his mind made up. So my sense is that at the meeting, he will initiate the easing cycle with 50. That's the prudent thing to do. I think if you drag out a bunch of 20, the argument that I hate the most is, well, 50 would represent a panic and they only go 25 in recalibrations. This is completely unlike previous cycles because of what's happened with the pandemic, with how far we are from their estimates of neutral and what's going on with inflation, right? So it's not like those are not fair comparisons in my opinion. But this idea that if they only go 25, that projects confidence. I mean, how about by the same logic, they shouldn't go at all?
Right. Right.
Like, let's just show so much confidence that we feel so good about things, we'll just leave rates unchanged.
What does it do politically, do you think? Because that's going to be the interpretation, right? If they go 50, well, let me back up and ask it a different way. You think Powell is in 50? I think they should go 50. I mean, for God's sakes, I think they should go 125 just to get to get to neutral. Obviously, they can't do that. But what do you think the other members of the committee, right? Because he does form a consensus, and you can sit there in that room and you can pound the table, but you really have to kind of bring.
So my view on that is, yes, the Fed's a consensus building institution, but once the chairman makes his case, the rest of these ducks fall into line. Like they're also, I mean, like you had like a few of them speak. I mean, I think William spoke about 15 minutes after the jobs number came out this morning. And you know, all he's saying is, yeah, we're going to cut, but he hasn't said anything about the time. I mean, the magnitude,
Right.
and the amount. And so, okay, useful. I mean, I just think that, you know, it's Powell is the consensus. Like whatever he says, most of them will fall into line once he says it. That's my opinion. I think he'll make his case. I think he has a very strong case to make. And I think a lot of them will fall into line. It's one of these things. I mean, if you survey like the Twitter, like the Twitter sort of crowd, it's interesting. I mean, you have these people that kind of tie themselves into knots by trying to, you know, kind of browbeat about how great the labor market is, um, while also trying to say that things are weakening. And, you know, it's kind of, it leads them into weird places. Like they don't want to sound too bad about the economy, but you know, in your heart of hearts, they would have no problem whatsoever if they decided to go 50.
Right.
Right? Like at some level, it's a sales job, right? Like if you want to go 50, you can't just say everything is fine.
Yeah, no doubt about it.
And so, and I think for a lot of these people, they kind of twist themselves into knots by trying to rationalize everything away.
I would think going 50 would be helpful to the incumbent, or I'm sorry, to the challenger, right? I think it would be helpful for Trump because you can start to spin a narrative of
well, it's about why they're going 50.
Right.
Like I think the idea that doing this to bail out Kamala is kind of ridiculous because they would have gone by now if they really wanted to do it. I mean, that's number one. But number two, I mean, the Fed was cutting really aggressively in 2008. I mean, it's kind of like, you know, so it's sort of, you know, I mean, the people that make the political argument, it's always sort of a heads I win, tails you lose sort of thing with them. But I do think that fundamentally, the challenger, in this case, the Republicans, can basically condition people to say, can we talk about why they're doing this?
Right.
They're doing this because our country's labor market is getting worse. It's getting worse under Comrade and Sleepy. There, you can just cut an ad with that. I mean,
right.
Look, I mean, I don't think the Fed actually thinks about it in those terms, frankly. And I, you know, I've strongly said that in the past, but you know, let's be clear about what's going on. They're doing this for really two reasons. Number one, inflation's running below 2%.
Yep.
And number two, at the margin, the labor markets are deteriorating. There's nothing about the downtick in the unemployment rate today that should make anyone comfortable in thinking that this is going to happen again. The likelihood is that we go back to 4.3 and then maybe 4.5 by year end.
Yeah, I mean, is there a risk that they only go 25 because they see it the same way that you just, you know, they frame it the same way that you did, right? And I think that's a big mistake.
Look, if they go 25 in September, then my call will be they'll go even more later.
Yeah.
Like,
right.
So,
at some point, you have to get to the neutral rate, and you either do it quickly or you do it over time, and the neutral rate.
Well, if you string, I mean, if you think about the cadence of Fed meetings, stringing out a bunch of 25s is a significant risk to the economy because you're running a restrictive policy stance really through next spring.
Right.
And I just think, I mean, no one knows what neutral is. All I know is that the Fed should be cutting until credit-sensitive areas of the economy turn in a convincing way. Now, when you have auto sales contracting for the last 3 months, we had a really weak auto sales number this week. Auto sales were a pretty important driver of consumption in the second quarter. When you have loan applications for purchase basically flat on their back, I mean, I don't think anyone really can say, despite the fact that, you know, mortgage rates have been coming down, I don't think anyone can really say that credit-sensitive parts of the economy have turned. And, you know, that's where I'm at. So I think, you know, if they don't go 50 in September, then they go 25, I think the markets would not be comfortable with that.
Yeah, I agree. Well, they're not comfortable with it already. But I want to ask you, I'm gonna get into that, but I want to ask you one thing. I thought that data was really interesting, which was purchasing applications were what, flat, if not down, while rates are down, right? And we've been hearing for a year, at least all of 2024, how all we need was 50 basis points, in mortgage rates, and the housing market was going to explode. And in terms of demand going through the roof, right? And that just has not played itself out in the data here.
Well, mortgage rates are about as low today as they were last spring. You know what's even lower today than it was last spring? Inflation.
Right.
And so a 6.5% mortgage rate with inflation running at 4.5% feels like a good deal. But if inflation is running at 2,
Right.
slightly below in recent months,
Yep.
6.5% isn't such a good deal.
Correct.
And people aren't stupid. I mean, they
Right.
get it. And at the same time, they're somewhat more concerned about their own personal labor market prospects. So I think that that's kind of keeping a bit of a lid here on housing activity.
Yeah. Yeah. Steve, in terms of the policy, the political environment, and we do take some flack on the policy side, even though I would say most of us here are pretty right down the middle. So I don't care. It just is what it is. If you can't take it, leave. Anyway, but the idea is, let's go to the betting markets, because I think the betting markets kind of encompass all the swing states, and just kind of everything. We don't have to worry about biases and polls. It kind of sees through that stuff historically. Just under $1 billion are traded in the prediction markets. From what I gathered, about $850 million notional is out there. So it's a relatively deep market, deep enough at least for statistical significance. It started to creep up, certainly still within, I'm sure, the margin of error of any poll, which was, I believe, 51% for Trump and 48% for Kamala. It's been deadlocked for the last 2 or 3 weeks. What do you attribute the change, and is it sustainable? And then historically, I know this is a multi-part question. What kind of swings do we see between, say, Labor Day and the final election? Does it really, shift where it becomes obvious, or does it stay relatively tight in these or I should say stable? Floor's yours.
Sure. So with respect to the movement in the betting markets towards Trump, I think that's a reflection of the lack of movement for Harris coming out of the convention. My sense is Harris, obviously did have some momentum with respect to the polls. I think Harris and her supporters were sort of hoping that they would receive continuation of that in a traditional post-convention ballot. So that hasn't materialized. And if you look at where Harris's poll numbers are relatively lower in certain states, specifically Georgia and Pennsylvania, compared to others, I think that's very significant, because Trump's going to have a higher floor with 235 electoral votes this time if you just assume that he wins all the same states that he won in 2020, where he had 232 electoral votes. The reason is the census. And so I bring that up is because you're talking about a pathway to 270. You need 35 electoral votes. And the fact that in the Real Clear Politics average of polls, Harris and Trump are tied in Pennsylvania. That has 19 electoral votes. Harris is, I believe, up by 0.1% in Georgia. That has 16. Not great with math, but if you add those two, I believe it comes up to 35, and that's why you see Trump spending a lot of money there. So my guess is that's what's being reflected now in the polls. And also, the betting markets tend to sort of play off what's going on in those polls. In terms of how much movement you get sort of between Labor Day and the election day, it's often sort of said that that's when the real, I guess, race sort of begins in terms of most people paying attention that maybe aren't that politically active. Historically, there've been larger swings, probably closer to like 4 or 5%, depending on how far back you want to go. Not surprisingly, and more recently, those swings have been closer to around 2.5, I believe, is what 538 said, because we're a reflection of a more polarized environment, and so you have fewer undecided voters out there. So I think that's what explains why the swings have been a little smaller, just because there are fewer persuadable and undecided voters out there. That said, 2.5 is significant because we're talking about polls and these
Right.
battleground states that are within oftentimes the margin of error less than 2.5%. So that sort of brings us to what's going to happen on Tuesday, and that is going to be the first and potentially only debate between Kamala Harris and Donald Trump. And I think Harris, and it's not a partisan statement, it's just a statement of fact, voters are less familiar with her. I know she's been vice president for a while. That's not uncommon for people not to be as familiar with the vice president. So her late entry in the race, I think, sort of makes her more volatile in terms of her support compared with Trump, who's been on the political scene for a decade now. And this will be, I think, his sixth general election debate. It'll be Harris's first. I know she participated in the VP debate. But again, she has more to gain and potentially more to lose. And so that's sort of what I'm watching for in the debate. I think both Harris and Trump are going to define the other as the incumbent, because if you look at the polls, very few people are satisfied with the direction of the country and where things are headed. And so my guess is there's going to be some back and forth there as to, who's really responsible for the quote unquote current environment. Trump's a former president. Obviously, Harris is part of the current administration. So that's sort of what I'd be on the lookout for Tuesday. I do think this has the potential to be more of a consequential debate because of that fluidity
Right.
with Harris compared to other ones. Because traditionally, a general election debate doesn't move many voters, just because most people sort of cheer for their respective sides. And we're talking about that very small sliver of people that may be influenced with this. I've gotten some questions about early voting, which I believe actually begins today, Friday, in North Carolina. I believe ballots have been mailed out. Most people that are undecided don't vote early. It just sort of makes sense. Can you sort of stack up some of your supporters early on? So I think that may be a little overblown. I remember in 2016 there was a lot of talk about Hillary, maybe surprised to the upside in the polls because of all this early voting. Obviously that didn't materialize, so we'll see what happens there.
Mm. I mean, has anybody looked into her record for how she handled the White House Easter egg hunt? I mean, I think that's kind of like the biggest event that the vice president seems to sponsor, right? That, and they show up for foreign dignitary funerals. I think like that's your role. You got to organize the Easter egg hunt, and you got to show up to the funerals. Is there anything else that you do?
Well, I traditionally the vice president has had a lower role, but that said, she was tasked with dealing with expanding voting rights at the very beginning of the Biden legislation or administration. Obviously, that didn't come to fruition. She was tasked with addressing the challenges at the southern border. You can draw your own conclusion about how effective she's been with that. And then more recently, pivoting towards playing a larger role on abortion access, which is I think at sometimes in the polls, I will say maybe misleading. If you just look at the issue areas, Trump still has a lead, albeit smaller than it was over Biden, over many of the areas such as the economy, inflation, immigration. A lot of voters are saying are top of mind in terms of their concerns. But Harris does have the lead on abortion. But Amy Walter from the Cook Political reported mentioned in 22 sort of this thought that if you're a Democrat, you're being asked by pollsters to say what issue, why are you voting for Democrats this cycle? Well, it's going to be difficult to point to the economy, immigration, or inflation. So abortion may be that logical justification if you're looking to provide some rationale to a pollster.
Well, it's a smart one too, right? Because look, half the electorate is analytical and kind of evidence based on what's good for the country, and from an economic standpoint, I would put the three of us more in that camp than not. And then the other half is historically very emotional, right? And respond well to those things. And obviously, abortion is a lightning rod. So it's a good strategy on their part for sure. Particularly to the extent that they frame their opponent as being anti abortion and using it as a rights issue. It's good strategy in my view. Neil, I'm going to talk a little bit about some of the things that we're seeing in the marketplace because I do think it's important, and this is why I don't look at data like you do. I look at the market and the market's message, and that one is pretty stark. I think one thing that is probably being underreported right now is this recent strength of the yen coming back, awaking from its August slumber, if you will, after it had that pretty vicious spike with the carry trade unwind. I don't know that I would characterize that as being done yet. There's some debate to that, but we'll see. The point being that the Nikkei looks vulnerable around that, and clearly this strengthening yen tends to be a liquidity drain, not a liquidity pump or stimulus. That said, what we're seeing is, for the first time really since 2023, the first part of 2023, tech in our model actually turned negative, right? So we've seen it in software. This is, the way that we operate is we look at things on a sub-industry, industry group basis, and then it finally will get to the sectors. And so we've seen it already in software. We've seen it in small cap semis. We've seen it in some other areas of tech, but now the Russell 1000 tech has turned negative in our relative strength work. So I think that's important. More than anything, because it tends to be more cyclical in nature, right? So we're also seeing it a little bit, not as meaningfully, but we're seeing it in discretionary versus staples. We're seeing it in cap goods, which rolled over on the Russell 3000. So obviously that's big, heavy machinery, equipment, etc. And so that's weaker as well. So there's a lot of things underneath this this market. Even though we're very close to a new high, there are plenty of things that suggest that in fact there is weakness underlying this economy that is reflected in markets. And I would also point, to the idea that, or the fact really, that twos and tens are trading just about at parity with one another. It's about right around 380 on the on yields for both. So we have a flat yield curve now. But maybe you can remind us, Neil, what happens, as you go into recession or as things slow down. The curve tends to steepen, right? I mean, that's just the way it works. So people want a steeper curve. That's true, and you do generally want a steeper curve, but the initial steepness does not necessarily bode well for the overall economic data. Would you agree?
Right, it's not the initial inversion, in other words, that's the recession signal. It's the bull steepening that happens as the Fed's cutting. Now,
that's called the oh shit moment.
Yeah, well, yeah, no, I mean, I get it. I don't know that I don't think that we're going into a recession, but I do because I think fundamentally this is a function of the Fed running a tight policy, which means that the Fed can easily resolve the issue. I mean, I've made this point to our clients, like we're not talking about a resolution trust corporation, a troubled asset relief program. I mean, this is really just about the Fed, as you mentioned, like getting the Fed funds rate to where the 2-year yield is, basically, right? I mean, that's all that is. And once that happens, I think you'll probably see things start to pick up a little bit. But yeah, I mean, it's historically, it's not the inversion that's the recession signal. It's the bull steepening that happens as the Fed's aggressively cutting, right? So that's the recession signal.
So between this will play.
And you tend to see stocks kind of, I think, historically bottom after that happens.
Yes. But if you buy the inversion historically, you buy about halfway through the bear market, right? So it usually tends to be. I'm sorry, you buy the steepening when you nullify the inversion. That's where it tends to be early. So you look at it and say, okay, this is a good thing overall, but it tends to be way too early to use it as a timing mechanism within the equity markets. Between now and the Fed meeting, which I believe is the 18th, what data points do we have that will be influential and possibly either solidify the Fed's thinking, which we don't know, or might refute the Fed's trajectory with this jobs number?
Well, I think so. Now we have the inflation data that come out next week. That'll be the CPI number. The market's looking for 0.2% on the headline. I think there might be some downside risk to that number. We'll see what, I mean, energy prices have softened over the month. Retail gas prices have come down. The next big one would be on the 17th, which is right before their meeting, and that's going to be retail sales. And, I think there's downside risk to that number as well, because auto sales were quite weak over the month. So I'd be surprised if we got a strong number. And then the Fed meets on the 18th. Now, I will tell you that what they're saying, I mean, it's hard to know, right? Because Williams is basically out on the tapes right as I'm speaking, and it sounds like he's okay with 25. And I'll just say, if they go 25, they're going 50s for more than they want, right? Like this is just when you go 50 when you can. You don't go 50 when you have to.
Right.
This sort of, to me, I just cannot stand the argument that it's a projection of confidence if they go 25. That it's like, you know, that is not the way to go. You know, I just think, I mean, it's sort of like saying, it's like William saying, I think he was the one that said, you know, 4 hikes are still in the ballpark back in 2016, and the Fed ended up going only once. I don't know. I mean, I don't know if it was him, but they were trying to project confidence the same way.
Right.
And what happens? You know, it's about risk management. And so I don't know. Like I feel like to me it's like so obvious. So maybe I have cognitive dissonance, but I just feel like if they go 25 in September, I think that would be a mistake. I think the underlying outlook for the economy is not good right now. And, you know, 25 would still mean that they're running a really restrictive stance. You know, stringing it out would be a big risk to the economy, and you'd be doing it needlessly. And look, in their mind, right? They've already, I mean, they wouldn't be going once if they didn't think they could go at least 3 times. So
Yeah,
all
right.
you're really saying is, okay, take one of the cuts you think you're going to do in November and just do it in September also. Done. Like that. Like, I don't understand. You know what I mean? It's like this sort of like, we must do it like this. And like, it's just this institutional bias and that they have, I think, in just going slow. But anyway.
Steve, what's on the docket other than the debate? Anything else happening in Washington?
Yeah, lawmakers return from their August recess, and all eyes are sort of at the end of the month where the fiscal year ends. So I think there's going to be some posturing until that point, but I don't really see a government shutdown as viable just because it's really not in either side's political interest. House Republicans are planning on moving an initial stopgap. Think of it as an opening offer in a negotiation. It's a longer duration into March. It includes something the SAVE Act, which will require identification for voting. That's not going to fly with Democrats, but I think the fact that they're talking about moving it earlier in this timeline till the end of the month suggests that eventually they're going to pivot something probably more in line with what Democrats want in terms of more cleaner CR, in terms of less policy riders, and presumably a shorter duration, probably through beginning of December, if I had to speculate. And then we'll find out how lame the lame duck session is, and that will depend on the congressional outcome. If we have a unified government control or divided, if divided, it may be a little more productive, just because you have a little more incentive to compromise, given that that's going to be the situation heading into next year, compared with if it's unified control, you just don't have as much incentive to negotiate with the other side. So that's, I think, all that's really going to happen now between the next 3 weeks. The only other thing I would flag is the House is going to consider called the China Week, a number of China-related bills. And so there's a chance that they might move an outbound investment screen legislation, something we've talked about before, as well as something as the Biosecure Act, looking to place restrictions on pharmaceutical companies. There's not enough time for the Senate to consider it, but again, that could potentially come up again during that lame duck session, just because Congress will have to do the annual defense bill. That's something that will not be punted into next year. And those China-related bills that have broad bipartisan support and a Senate companion are sort of ripe to hitch a ride on that NDA train at the end of the year. So that's sort of how I think about it.
Well, we'll continue to watch the cyclical versus defense. That is a pretty clear historical underdog after the Fed cuts. So, you know, despite I think people believing that the cavalry's coming once you cut rates, you do tend to have softer data around that, and that tends to be bad news for cyclicals. And again, we're seeing that with some of the cap goods. We're seeing it with tech, and we're seeing it in select consumer discretionaries. Really, with utilities, REITs, and notably financials are holding up, which I think is good news for the soft landing crowd, and certainly we're in that as well. But those will be important. We get a good oversold condition sometime during the seasonal weakness. That probably happens before the election because the markets are pretty good at figuring out who's going to win, and we'll be looking at that as an opportunity. But for now, we're certainly playing with our hands underneath our thighs, if you will, for a few more weeks as the seasonals play themselves out. So join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and our YouTube channel, RenMac. If you go, you'll be able to see our lovely faces as we do this podcast. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.